Breaking news, everyone. This is the moment we've all been waiting for. The Federal Reserve has just officially announced the end of its quantitative tightening program. For the past couple of years, the Fed has been shrinking its balance sheet, pulling money out of the financial system, and now that's coming to a halt. What does this mean for you, for your investments, and for the broader economy? Well, get ready, because things are about to get very interesting. This isn't just a minor policy tweak, it's a monumental shift that could send shockwaves through every asset class, from stocks to crypto to real estate. In this video, we're going to break down exactly what quantitative tightening is, why the Fed decided to end it now, and most importantly, what the explosive implications are for the markets. Stick with me, because you're going to want to know what's coming next. First, let's do a quick, simple recap. What exactly is quantitative tightening, or QT? Think of the economy as a giant swimming pool. After the 2008 financial crisis, and again during the pandemic, the Fed pumped massive amounts of water, or money, into this pool to keep everything afloat. They did this by buying up bonds, which is known as quantitative easing, or QE. It was like turning on a giant fire hose of cash. But recently, with inflation running hot, the Fed needed to drain some of that water out. That's QT. They started letting those bonds mature without reinvesting the proceeds, effectively taking money out of the system. This makes borrowing more expensive, slows down the economy, and is generally seen as a headwind for asset prices. So for the past 2 years, this has been putting a damper on the markets. But now, the Fed is turning off that drain. The water level will stop falling. So the big question is, why now? Why did the Fed decide to end QT? There are a few key reasons. First, and this is a big one, there have been growing signs of stress in the banking system. You might remember the regional bank turmoil last year. Pulling too much liquidity out of the system can cause things to break. The Fed is trying to avoid another crisis. They want to make sure there's enough cash sloshing around for banks to operate smoothly. Second, inflation has been trending down. While it's not at their 2% target yet, it's come a long way from its peak. This gives the Fed more breathing room. They no longer need to be as aggressive in tightening financial conditions. Finally, there's the government's massive borrowing needs. The US Treasury needs to issue a ton of debt to fund government spending. And without the Fed as a major buyer, there were concerns about who would soak up all those bonds. Ending QT helps stabilize the bond market. Essentially, the Fed is taking its foot off the brake. They're not hitting the gas yet by cutting rates, but they've stopped actively slowing things down. Now, let's get to the part you've been waiting for. What does this mean for the markets? In short, this could be like pouring rocket fuel on an already simmering fire. Ending QT is a major dovish pivot. It signals that the central bank is shifting its focus from fighting inflation to ensuring financial stability and supporting growth. Historically, when the Fed moves from tightening to a more accommodative stance, markets tend to rally, and rally hard. First up, the stock market. With liquidity no longer being drained, there's more capital available to flow into equities. This is particularly bullish for growth and tech stocks, which are very sensitive to liquidity conditions. Think about it. For 2 years, these stocks have been fighting against a current. Now that current has stopped. We could see a major reacceleration in the trends we saw during the QE era. The Nasdaq and other tech-heavy indices could be poised for a significant move higher. The S&P 500 could break out to new all-time highs with more conviction. This isn't just a short-term blip, it's a fundamental change in the market environment. What about other assets? Let's talk about cryptocurrency. Crypto markets are the ultimate high-beta play on global liquidity. When money is cheap and plentiful, assets like Bitcoin and Ethereum tend to soar. The end of QT is a massive tailwind for the digital asset space. We've already seen how crypto reacts to positive macro news, and this is about as positive as it gets. With more dollars in the system and a renewed appetite for risk, we could see a fresh wave of capital flooding into crypto, potentially kicking off the next major bull run. This development, combined with things like the Bitcoin halving and the launch of spot ETFs, creates a potent cocktail for explosive price action. If you've been on the sidelines, now might be the time to start paying very close attention. The liquidity on trade is back, and crypto is often its biggest beneficiary. And it doesn't stop there. Think about real estate and precious metals. The end of QT puts downward pressure on long-term interest rates, which is great news for the housing market. Lower mortgage rates make homes more affordable and could reignite demand. For gold and silver, the story is also bullish. A more dovish Fed typically leads to a weaker dollar over time. Since precious metals are priced in dollars, a weaker dollar makes them cheaper for foreign buyers, boosting demand. Furthermore, in an environment of financial easing, investors often turn to gold as a store of value and a hedge against potential future inflation, which could be a consequence of all this renewed liquidity. So, we're looking at a potential broad-based rally across almost all asset classes. This is a classic risk-on signal from the most powerful central bank in the world. So, how should you position your portfolio to take advantage of this massive shift? Of course, this isn't financial advice, but I'll share how I'm thinking about it. First, it's time to reevaluate your cash position. Sitting on too much cash in a high liquidity environment means you're missing out on potential gains, and its purchasing power could be eroded by inflation. Second, consider overweighting assets that benefit from increased liquidity. This means looking at growth stocks, particularly in the technology and innovation sectors. These companies thrive when capital is readily available for expansion and investment. Third, have some exposure to the high beta plays like cryptocurrency. The potential upside is significant, though remember, it comes with higher risk. A small strategic allocation could pay off handsomely. And finally, don't forget about the traditional inflation hedges like gold. If this new wave of liquidity eventually sparks another round of inflation, you'll be glad you had some protection. The key is to be diversified, but tilted towards growth and risk assets. The era of a restrictive Fed is over, and the market playbook is changing right before our eyes. But let's also consider the risks. What could go wrong? The main risk is that inflation comes roaring back. If the economy reignites too quickly and price pressures build up again, the Fed could be forced to reverse course. They might have to slam on the brakes again, potentially even harder than before. That would be a major shock to the markets and would likely cause a sharp downturn. Another risk is that this move is a signal of underlying weakness. Perhaps the Fed is seeing something concerning under the hood of the economy or the banking system that isn't yet public knowledge. If they're ending QT not from a position of strength, but out of fear that something is about to break, then the initial rally could be a bull trap before a bigger problem emerges. It's crucial to stay informed and watch the economic data closely. Pay attention to the monthly inflation reports and employment numbers. These will be the key indicators that tell us whether this new policy is working or backfiring. While the outlook is overwhelmingly positive right now, it's always wise to be aware of the potential pitfalls. To sum it all up, the Federal Reserve ending quantitative tightening is a game changer. It removes a major headwind that has been suppressing asset prices for the past 2 years. It's a clear signal that the policy environment is becoming much more favorable for investors. We're moving from a world of liquidity withdrawal to a world of liquidity stability and potentially future liquidity injection. This has historically been the launchpad for major bull markets in stocks, crypto, and other risk assets. The path seems clear for a significant market rally. However, remember to stay vigilant for a potential resurgence in inflation, as that's the one thing that could derail this entire bullish narrative. The coming months are going to be absolutely critical and potentially incredibly profitable for those who are positioned correctly. Don't be the one sitting on the sidelines watching it happen. Thank you so much for watching. This is a fast-moving story, and I'll be tracking it every step of the way to keep you updated. If you found this breakdown helpful and want to stay ahead of the curve on major market-moving events, make sure to hit that like button and subscribe to the channel. Don't forget to ring the notification bell so you don't miss any future updates. What do you think about the Fed's decision? Are you bullish or are you cautious? Let me know your thoughts in the comments below. I read every single one. Thanks again, and I'll see you in the next video.